recording.
Okay. All right, now I'm going to erase this because we're going to move on, and there's a little bit more you need to know about community property. So if you didn't have it, just rewind it a few and freeze it. So we're just going to go a little bit more in depth about the difference between community and separate property. Okay. So one thing that may come up in a bank account is, so we talked about tracing, and we said that a good way to, let me use a different marker. So a way that you can know if it's separate property is by tracing the purchase to separate property, to a separate account. But let's say accounts get commingled. And so what can happen sometimes is your separate property, your separate bank account can maybe get commingled. Maybe you cashed a check or some money, you and your spouse collectively, the money got put together, and even though you maybe had $1 million from your inheritance in this account, maybe the wife had, I don't know, $500 that was given as a wedding gift, and you just went ahead and put it in this account. So in this case, the burden of proof is on the separate property here, because this is the husband's account saying, oh no, this is all my money, this is my money, you only have 500. In this case, it would be on the husband, burden of proof would be on him to prove that the separate property funds were used to purchase the asset. What does that mean? It means this house that was purchased in cash, let's say it was purchased for $750,000. It's on him to prove that it was this money used and not this money. So they can do that by direct tracing, which is to show that there was sufficient separate property funds available at the time of purchase, and that the spouse had the intent to use them to purchase an asset. Another way that you could do it is by just proving that there wasn't enough money to buy this house with community property funds. You can show that the community property funds were already exhausted in this account. Like this $500 can't buy a house, okay? There is a presumption, so moving on from this scenario, there's a presumption in commingled accounts, let's say joint accounts. There's a presumption in joint accounts that community property funds are used to pay family expenses. So your rent, your utilities, your vacations. That was community property. Separate property funds are used only when community property funds are exhausted, and separate property funds used for family expenses are a gift to the community. So if you use your separate account to pay these family expenses, rent, utilities, or vacation, that was just nice of you. That was a gift to the community property. So what they say is, what the courts are going to basically say is that any money spent during the marriage on the family is community property. And what you would need is an agreement to reimburse. Typically, if you're going to argue that let's move on, I forget what I was saying. So if tracing is your best option at keeping your separate property separate. You need to trace it to a separate account. Now let's say if the money came out of a commingled account, came out of a joint account, well, the court's gonna say any money you put into this joint account for rent, utilities, and vacations is community property. So if you're always putting $10,000 a month in it and spending that $10,000, then the court's gonna say, no, it's community property. But if you put, I don't know, $1 million into that joint account, and you can show an agreement to reimburse you for that money, is the only way that you can really defeat this presumption. Okay, moving on. We're going to move on to separate property business increases in value during a marriage. So there are two different formulas that can be used when a business increases in value during the marriage. The first one is Pereira. This method of accounting should be used when the increase in value of a business is attributed to personal skills, such as the spouse's personal time, character, energy, or ability. And the formula for that is the separate property equals the value. So in this case, there's a business, there's a dry cleaning business. When they first got married, it was worth $5,000. When they got divorced, it was worth $50,000. And in this situation, the business is predominantly run by the wife, who says, no, this increase, this was me. This was due to my personal skills. This is due to my character, my energy, and the time I put into this dry cleaning business. And so the court says, okay, then you can take of this, profit, this increase in value, you can take, the wife can get the value of the separate property plus the value of the business at the time of the marriage. So the value again, times a fair rate of return, do R, fair rate of return, times years of marriage. So let's say they were married 10 years, times 10. And that's about as much as I know about that. If you want to know more about fair rate of return, etc., then I would advise you to Google it. But the courts say that if there was an increase in value of a business due to one of the spouse's personal attributes and value, their personal skills, then that person can recover more. The second method that the court will use to determine is the Van Camp. And the Van Camp assumes that the character of the separate business itself is the primary reason for its growth. It assumes the managing spouse's services were ordinary, and it imputes a market rate salary for those services. So the equation here is community property, and this is separate property, so I put W for wife, but the separate property that the wife in that scenario would get is the value plus the value times the variable rate of return times years of marriage. The Van Camp is your community property, is the reasonable value of services provided during the marriage minus the salary already paid. The rest is separate property of the managing spouse. So, Wendy has taken a salary of $25,000 a year, and she paid family expenses of $5,000 per year. Her services at COINCO were worth $40,000 per year under Van Camp, which Wendy would argue should apply given the renewed interest in coin collecting in the community. The formula would be as follows: $40,000, which is the value of services, times 5 years, which is the length of time the business operated, equals $200,000 of reasonable services provided during the marriage. This is the money that the community should have earned. $125,000 of her salary and $25,000 of family expenses were already paid to the community. The amount already paid to the community totals $150,000, so $200,000 what the community deserves minus $150,000 what was already paid equals $50,000. Since the business was valued at $100,000 at the time of dissolution, $50,000 should go to the community as income that should have been paid, and $50,000 would be Wendy's separate property. Well, hopefully you understood that better than I did. Alright, moving on. Educational degrees and expenses. A professional degree earned during the degrees. Marker's dying. Well, yeah, I understand it because they turned that profit and translated it into income and then said, well, lady, your income is community property, so yeah. It's basically saying that, like, the business would have been doing well no matter what. Doesn't matter what you did. Okay, degrees. So, professional degrees earned during the marriage is not divisible at divorce. Reimbursement. Educational expenses are generally not. So degrees are separate property. Educational expenses are generally not community property, but the community property estate may be entitled to reimbursement limited to tuition, fees, and books, not living expenses. So that's something to note. If you are the wife and you helped, we should make these gender neutral. If you're the wife and you helped your wife get a degree by paying for their education, then the court says you are entitled to reimbursement for tuition and books, but not living expenses. No living expenses. Okay. So, a professional practice and goodwill of a professional practice. Goodwill is an intangible business asset that is calculated based on the expectation of future business due to the name and reputation of the entity. This is treated like community property if it is created during the marriage. Goodwill is measured by market valuation or by capitalization of past excess earnings. Generally, this is established with expert testimony or comparing the business with other similar businesses. So this is just saying that if you create an enterprise sort of together, that like a professional practice together, then you can divide the intangible business assets by basically, this is really discussing intangibles, business assets, by putting a market value on them, basically. And dividing that. Insurance policy. When a spouse is named someone other than the other spouse as a beneficiary of his or her insurance policy, there are two types of insurance policies to be aware of. Whole life insurance. This type of insurance is guaranteed to remain in effect during insured lifetime so long as premiums are paid. The rule is that a court will classify an insurance policy as community property. So the insurance equals community property in proportion to the number of premium payments made with community funds. So the example is that husband names his niece as the beneficiary of his insurance policy. He makes 2 payments before he is married and 8 payments after marriage. The policy is 20% separate property and 80% community property. If the policy is worth $100,000, when husband dies, the wife will recover $40,000, her half of the community property. I hope that makes sense, kind of pretty easy to understand. It's the percentage of the life insurance policy that you'll get is based off of the percent of payments that were made with community funds. Okay, and then term life insurance only covers risk of death during a certain time period. Look to see if the couple is divorced or if the policyholder dies. If the couple is divorced, the policy holds no value for the divorced spouse. If the policyholder dies, the courts will take one of two approaches. They will apportion the community interest using the same approach as above, or look to the final premium payments to determine if it should be considered separate or community property. Next is pensions. Pensions are treated as community property. To calculate the amount the non-participant spouse will receive, check to see if the participant spouse is eligible for benefits upon divorce or not. If the participant spouse is eligible for benefits upon divorce, then use the time rule and divide the years the spouse was employed during the marriage by the total number of years of participating in the retirement fund. So similar to the insurance, it's if they're allowed to withdraw from this pension, then you take the percentage that was of payments that were made during the marriage and the percentage of that were made before the marriage, and that's how much is community property. Now, if they are not eligible for benefits upon divorce, the court may use one of two of the methods, or of two methods to calculate the amount the non-participant spouse will receive. Division in kind rule. The non-participant spouse will receive a percentage of each paycheck using the time rule method, or a cash out rule. The non-participant spouse is cashed out upon divorce after determining the present value of the benefits. So the same way, you just determine how many payments were made during the marriage, how many payments were made before the marriage, and that's the percentage that the spouse is entitled to. Similarly with disability, severance pay, and other disability, look at when disability pay is received, not earned. Severance is community property. structured just like retirement benefits. It is separate property if it's meant to replace lost earnings after divorce or separation. And then I'm gonna skip stock options, but if you wanna go look at your outlines, you can review stock options, joint titles, and capital improvements. Property that is jointly titled, i.e. in both spouses' name, is presumed to be community property upon divorce. Community property with the right of survivorship is permitted if expressly in the deed. It is treated as community property if the parties divorce, but the right of survivorship applies upon death. Capital improvements, you have the right to when a spouse contributes separate property to improve community property and title is taken jointly. If a spouse dies, the community property presumption applies. That is, if the property is purchased in part with a spouse's separate property, it is still presumptively community property, absent an agreement that says otherwise. That goes along with the commingling funds. If parties divorce or separate, then there are two anti-Lucas statutes on the ownership and reimbursement issue. Property acquired in joint form is presumptively community property, subject to equal division, but this will be reviewed by an express statement in the deed or instrument of title or a written agreement that the property is separate property. Reimbursement. A spouse is entitled to reimbursement without interest for any down payments, improvements made, or payments on the principal of the mortgage. Okay, I'm gonna skip ahead. And the rest of this is going to talk about debts, and generally the rule is that any debts occurred during the marriage are community property. So any debts incurred during the marriage by either spouse is community property, and so either spouse is liable for it. So a question may be, can creditors reach separate property? Creditors cannot reach separate property of the non-debtor spouse for premarital debts. Creditors can reach separate property if the non-debtor spouse for necessities like food, medical expenses, shelter. If a party is living together, a married person is personally responsible for the necessaries of life if the married couple, a married person is personally responsible for the necessaries of life if the married couple is living together. If living apart, a married person is only responsible for common necessities of life, such as health insurance, medical, right of reimbursement. If the debtor spouse had separate property or community property funds at the time the debt was paid, the non-debtor spouse can be reimbursed for any separate funds used to pay the debt. Okay, there is a little preview about tort liability. The general rule is that if the tortfeasor was acting for the benefit of the community, the debt is first satisfied from community property, then from the tortfeasor's separate property. So if they were not acting for the benefit of the community, the debt is first satisfied from tortfeasor's separate property, then the community estate. The non-tortfeasor's separate property is not liable. So in either case, if there's a tort debt incurred during the marriage, then the non-tortfeasor's separate property is not liable. And if it was to benefit the marriage, then it'll use community funds, then separate funds. And if it was not to benefit the community, then it'll use private separate funds, then community. So the situation with premarital debt is that creditors can go after your community property in a joint account to satisfy the premarital debts, but they cannot go after their separate accounts or when there's no commingling that's taking place. So if the moneyed spouse has kept all their finances separate, then the creditors cannot go after that separate account. A couple and their ownership rights. So a couple who owns real property together must participate in any major real property transactions, such as selling the property, leasing it for longer than a year, or encumbering the real property. The presumption is that the title is held by both spouses. When the title is held by one spouse, the transaction is presumed valid if the purchaser in good faith did not know the seller was married. Fiduciary duty. Spouses have the highest duty of good faith in the management or control of community property. Neither spouse may take unfair advantage of the other. A breach requires a showing or deliberate misappropriation, recklessness, or grossly negligent conduct. A presumption of undue influence arises when one spouse gains an advantage over the other in a property transaction. The spouse who gained the advantage bears the burden of rebuting this presumption and must show that the disadvantaged party freely entered into the transaction. Okay, that is the end of community property. Thank you guys for watching. I know this one was a long one. Coming up next this week is agency, partnerships, and corporations. Okay, thank you. Good luck.